Everyone, Jesse Webb, Traders Pro. Market conditions, bearish in a bull market, continuing to see some acceleration to the downside. We are now approaching some extreme levels to the downside that oftentimes will create an area for some support, an opportunity for a bounce, whether that's just a shorter term reprieve or whether it actually starts to create a new bottom within this overall uptrend. Obviously is yet to be seen, but we've got this momentum indicator now moving down to the extreme range. I mentioned this in the update last time that once it reaches this area, it can certainly, in this case, it can go lower. It can get down to this negative 250, 300 area if we really do continue to see some acceleration. We're starting to see this three-part counter trend that often shows up in a retracement, such as this. This is a little bit more than that, but oftentimes you'll see that three-part counter trend, and that last move lower really clears out the remaining sellers in the group. So we'll see if we get any continuation of that move today, or if we start to see some bounce at this level. We saw the momentum is deeply oversold here. Breadth is now also entering that range, and there's some additional indicators to look at on that also. So the overall sentiment in this case has not created a lot of fear. We haven't seen a lot of spiking in sentiment and volatility here, or at least risk type perspectives. Not yet, not a panic type of scenario right here. It's been relatively slow and orderly, and typically based on what the Fed is doing. Still, interest rates and Fed are still an issue. We talk about the bond yield curve. This is going to continue to be an issue going forward because, as I've mentioned in the past, this line, this red line that's right here, is an inverted yield curve, which means that the shorter term interest rates are paying higher than the longer term interest rates. And typically on a bond yield curve, when they talk about an inverted yield curve, it's usually that 2-year and 10-year. So you can see the 2-year is paying more money than even the 30-year. So even the 3-month is paying more money than the 30-year. So that just is not that's not a healthy scenario going forward. It has to change, and it typically has. This chart is 20 years. If I go back to 2000 at this market, as things are changing, you can see this dragging along right here. And at the top of 2000, we had an inverted yield curve or flattening curve, and you can see what happens when the market started to retrace back down during that dot-com bubble. And this is what a typical yield curve looks like when you have a lower interest rate paying less than the higher interest rate. And as we move back up, you can see we ran into that scenario in 2007 and 8 again. We ended up having that nasty market crash in 2008. And as we've been climbing, you can see the interest rates, the yield curve is healthy looking, but the interest rates are just super low. And then we ran into COVID about right here, and you can see what happened to interest rates across the board, almost flat, just entirely nothing, just giving money away. That move is what we're dealing with now. So if we watch this and it starts to come back, now we're dealing with inflation. Rates are climbing, watching that red line. Okay, rates are climbing, and this is where we're at right now. So this entire move from this COVID recovery top, as we started to retrace last year, now we had a flat yield curve. Now as the market is rallying, anticipating better things to come, we have an inverted yield curve still. So if we look at that location here, we look at that location here, that doesn't look like this, and it doesn't look like this. So what's left to come still may be in the works, but overall we need to be paying attention to that price activity. On the downside, though, on the extreme, let's look at buy-sell ratio, because we are widening right here again and getting to that range where it just typically, it can go a lot more than that, but this is actually a pretty significant bottom from last year, and we may not see that kind of capitulation selling where we're getting a lot more stocks in that database that are looking to the downside, but we're getting there. In fact, buy-sell ratio on this indexes tab across the board now, we've got Dow, which is 0.11, so almost all stocks in downtrends. You can see 0.11, 0.12 on the composite, 0.14 on and 1.6. These are starting to get into that low number on the buy-sell ratio. Again, that's going to match up pretty closely to this number right here. So this ends up being the total database buy-sell ratio, 0.17. That's getting in that area where we can start to watch for a bounce, and also sentiment here as well. That being said, we have a lot of momentum starting to move to the downside, and want to be cautious of that overall price activity as well. Let me change a couple things here, and let me add this back in. A little bit more of a look like something like this. So now you can see we've been talking about S&P 500 and that 432 level. We've broken it. Now we're sliding down through that again here. We've got a support area that's just sitting right around this range. Okay, so we'll watch to see if we slide a little bit more, maybe down to this 50% range. And again, deeply oversold, and we working on that three-part counter trend. We could get a bounce, just maybe be a little reprieve bounce. We could see some continuation of this, some selling, but whatever's going to happen here in the next few days is going to be a little bit more intense, more than probably than we all want. We could be sliding now right through this area all the way back down. This is the 1 year time frame, again on SPY. So this overall uptrend from this low to this high, running into that upper range, that momentum range is starting to fail. And we could, the real next major support areas are going to be right around here, right around this 416 area. So could be a pretty big void right here, and markets could get pretty sketchy right here. Certainly want to use caution, sit it out, sit on your hands. Even if there are going to be stocks in the new buy list, these are just not great market conditions to be overly aggressive. Let's take a look at some of these stocks here and see. There's some pharma stocks that are popping in. OLMA, this has been a good one all year long, really with only one sell signal moving. Not a lot of volatility for a $3 or $4 or $5 stock that's gone to 10. That's an interesting stock to keep an eye on. Certainly for today. Let's jump over here and go to the next couple. Buyout stock. SVRA, another biotech medical drug, $3 stock, real tight consolidation. This one keeps going back and forth from hold to buy. So but in the upper momentum zone as well, with all buy profiles currently, meaning everything here is in that buy zone, and we're up above this 236 area, connecting this high and this low. We want to see stocks that are continuing to trend will typically stay in this upper range of the chart and just continue to follow those until they break down. FTI, oil and energy, still seeing oil and energy showing up in a lot of these scans, but you'll notice the last 3 or 4, medical, biomedical, and one oil, finance stock with the buyout. Taboola, which is a tech stock, online media and advertising, and another oil play. Base material, steel stock, U.S. Steel. This is also a nice pattern. Had a big gap higher, probably on some earnings, and just been consolidating, and now starting to trend back up towards the upper end of that range. Seeing base materials move with, mining stocks and gold and different things that are working that direction. That'll do it for today's update. Everybody have a fantastic day.